Good morning, everybody, and welcome to the second day of the 2019 Precious Metals Summit in Zurich. And this morning we have a real treat for you because sitting on our stage in front of you is John Hathaway, who's chairman of Tocqueville Management Corporation, and Anthony Vaccaro, group publisher of the Northern Mining Group. And just a couple of words, because neither of these gentlemen need much introduction, but as most of you are aware, John Hathaway is one of the most prominent gold fund managers in the world, and he's a contrarian investor. He speaks at a lot of events and in the media, and it's just great to have you here, John. Thank you very much. It's your first time in Zurich, but probably the sixth time you've spoken at a Precious Metals Summit. So he's also chairman of our advisory committee for the group, so we really appreciate you being here. Anthony has had a long and excellent career with the Northern Miner. I remember back 10 years or so ago you were a reporter.
That's right.
And then you became the editor. And now you're the publisher, and not just the Northern Miner, which is one of the most preeminent publications that writes about mineral exploration and with a focus on on the Canadian industry, but they also publish the Canadian Mining Journal and Mines Handbook. So it's a great pleasure and an honor to have you both here this morning, and I will now turn it over to Anthony. Thank you.
Thank you so much, Jessica. Well, what an honor to sit down with John Hathaway. It's not often that you get to have quality time with such an esteemed investor with such a very strong career. John, you've had 25 years as one leading investor in the gold space, in the precious metal space. But your investment career goes back further than that. You started in the 1970s. So I thought to get things going, when you have that sort of perspective on the industry over that time, maybe have an opportunity to share with us what history can teach us about where we are in the gold equity cycle. And I have a chart here that we're going to put up. There. Oh, no, that's not the right one. Just go through here. Yeah, we're just seeing the two here. That's the one. Okay, so here we're looking at gold equity dislocation from the S&P 500 since 1993. So a bit of a historical perspective. And we'll dive in a little bit from here. But I thought this would be a good place to start. If you could maybe talk about what we're seeing in this chart and how this is relevant to where we find ourselves at this particular juncture in time.
Sure. Gold stocks have been laggards since 2011. By a huge factor. That suggests to me that we are more in a buying range than not. On the other side of it, stocks look very high. They're expensive. They've been driven by monetary policy, zero interest rates, and all of that sort of thing. So this is the widest gap between the gold mining complex and the S&P, obviously, in this almost, 25-year history. And to me, it smells of opportunity. Mm-hmm. We'll probably talk about reasons why, but I think this is a good place to start.
And we will talk about reason whys, particularly on your views on the gold price and gold equities. But this is also a good chart to talk a little bit about the S&P because of your career. You've seen where that's gone. My understanding is right now market breadth is extremely narrow, but price averages are near all-time highs.
Right.
That's a bit anomalous. That doesn't always happen. Is there other points in history where you've seen this sort of thing happen, and how did that play out?
Yes. And there may not be that many in the room that remember, but in the early 1970s, there was a phenomenon of the Nifty 50, and they were the 50 stocks anointed by J.P. Morgan, and they were called various things. And in those days, I worked with a firm called Spencer Trask, which was one of the gurus behind these growth stocks. And the thesis was, the investment thesis was, that it never mattered what you paid for growth, because growth would always bail you out. And in fact, we called them desert island stocks. You could go to a desert island for 20 years and you would come back and your portfolio would be just fine. And they were also called one decision stocks. All you had to do was buy them. The problem was the decision was the wrong decision. The one decision was that you should never have owned them in the first place. Then you go back to then, and you had, it isn't at the scale that we have today, but there was a kind of a mania, and the market averages were propped up by these 50 different, and they were such stalwarts as Avon Products, Polaroid, Eastman Kodak, and Simplicity Pattern. Those are four that come to mind. Most of them aren't even around today. So had you been on a desert island and come back even 10 years later, your portfolio would have been obliterated. And I kind of think today you see, and this is not to disparage Amazon or Facebook or any of these investment darlings, but what we're seeing today in market behavior is investors crowding into a smaller and smaller number of stocks. And we're starting to see them come apart one by one. Amazon is still doing okay. Google is probably doing okay. And Facebook in terms of stock performance. But we're starting to see one by one they're getting picked off. And certainly you see the unicorns like WeWork getting obliterated and Uber and so forth. It to me is very similar to what we saw in the behavior of the market in '74, and history rhymes and there's a repeat factor, and I kind of think that's where we are today. Beneath the surface, you see a lot of termites at work, and the market breadth isn't that great. And I think this quarter, FactSet is reporting a decline across the board in earnings of it's a little over 2%. And I don't want to rattle on too long about it, but what we're seeing today is not without precedent.
Mm-hmm. Well, listen, it's very important that we take stock of the overall market. And another metric that's come up that could be telling for the audience is on the IPOs. So staying with earnings. So roughly 75% of IPOs this year had negative earnings. The number was very high last year.
Right.
Again, with this idea of history rhyming, when's the last time we've seen those kind of levels of negative earning IPOs?
Well, that's a little reminiscent of dot-com. And I love the metrics. What was WeWork's metric was community-adjusted EBITDA, whatever that is.
Yeah, what is that?
I don't know. Even the SEC wouldn't let that go through. So yeah, this is reminiscent of the dot-com bubble.
And we all know how that played out. So a big topic here that's been coming up in our industry over the last little while is the generalist investor, what it's going to take for them to come back. So we're already pointing to some warning signs on the general market that might make them look elsewhere. We've had, as Ronnie pointed out yesterday, Ray Dalio is now being more positive on gold, Rick Reed from Blackwater, even David Rosenberg. So a lot of leading luminaries in the investment space are saying positive things about gold, but we still haven't seen that move in terms of a healthy revaluation of gold equities. Why not? What's holding general fund managers back from investing in gold?
I can think of a couple of reasons. One is there's probably still a hangover from the bad experience investors have had going back to the peak in 2011 about corporate governance, capital allocation decisions. So that would be one. In my view, the industry is far better today on those counts than it was in 2010, 2011. A second thing is these stocks have been in hibernation for a long time, and we're probably one of the last men standing in terms of active management in the space, and that gets into passive ETFs, passive management. I think that's had a factor, and one of the things it suggests to me is that the flows in and out of the precious metal stocks are enabled and abetted by the availability of an instrument like GDX. And so investors, if they are generalists who want exposure here, don't have to do any homework on the underlying companies. And what we have noticed as generalist investors, as value investors, is a huge valuation gap between the big cap names, Newmont, Barrick to name two, Newcrest would be an Agnico. Those are four that come to mind that probably account for 35 to 40% of the weighting in GDX. And then there are obviously other names represented. But if you go down the scale to the mid and smaller cap companies, it's not hard to find companies with valuations that are in the single digits in terms of multiple enterprise value to EBITDA, many of them generating free cash flow. And I've been doing this now for 20 plus years, and I don't remember any time in those 2 decades plus, that you could find those kinds of values. And as you mentioned earlier, I came into this business back in the early 70s, and there was a time in the late 1970s when you could find very good quality companies trading at single-digit PE multiples with dividend yields that were 3, 4, 5%. We don't have that in the gold mining space, but you're beginning to see companies pay dividends. But the value proposition today, beneath the surface, and the big cap stocks to me are cheap relative to gold, but beneath the surface, the mid to smaller cap stocks are even cheaper. And again, I think going back to your first chart, it spells tremendous opportunity. If I were a generalist, which I'm not now, but when I would have looked at this. But the problem is that gold has gotten a stigma, and certainly to be sort of supportive of it within let's say, an investment discussion in a large generalist firm, you immediately isolate yourself. If you recommend a stock like Facebook to your peers and to your clients, and the stock goes down, well, you're fine because you're just everybody else is doing it. But if you recommend, let's take one of our favorites, Torex, to your peers and colleagues, and it goes down, you could be out of a job. Because gold is the third rail of investment ideas. And I think all of this feeds into why the stocks are cheap and why the opportunity today, again, as a generalist, contrarian, is the best I've seen it since I've been at this.
And the problem with going with the flow is it's very hard to generate alpha if you're going with the flow. So that's the opportunity for investors.
I wish I had this chart for you, but it just came to me too late. If you look at the earnings revisions this year for the largest 20 S&P companies, on the left-hand side of the chart at the beginning of the year, it's a steady path downward. But if you look at the earnings revisions for the gold mining shares, it's a steady path from the left-hand side of the page to the right-hand side upwards, and they kind of cross over. So earnings for gold mining companies are going up. The gold price is higher. Costs have been relatively contained. And I think the sell-side analysts have generally been scrambling to up their estimates. Again, it's a phenomenon where nobody seems to be taking notice. I mean, even though the stocks are up, on average, well into the 20 to 30% area, they're still way behind where, in my mind, they ought to be, given where the gold price is.
Well, if the general investors don't want to take notice, then rival executives might be taking notice. So let's turn to M&A. Okay. So to set this up, let me set the stage a little bit here. 50% of iron ore production comes from just 4 companies. 50% of copper production comes from just 10 companies. But 45% of gold production comes from 25 companies. When you hear a stat like that, does that argue for, we did obviously see some M&A activity pick up this year, but is there still more that needs to happen?
Well, the M&A that we've seen has been mergers of equals. So Barrick gets together with Randgold, Newmont gets together with Goldcorp. I'm not saying they're equal, but they're big mergers with not a lot of incremental value add for the shareholders of either company, and it's all will be worked out over time. What we haven't seen very much of, and what I think we will see more of, are, and once the dust settles, when these large companies kind of sort out their portfolios and probably divest a couple of their mines, reconfigure into different companies, I think you will see M&A where you have a good deal of accretion, not only for the company being bought, but for the acquiring company. And that's because, well, two things. You should back up and say that the mine life of the mining industry is the lowest in 3 decades. And so they're running out of headway for future production. And every year that goes by, and we've seen big cutbacks in exploration and development. I don't have the numbers off the top of my head, but the spend is down. You certainly see within the mining companies a lot of termination and cutbacks on mining, on exploration. So we also have seen that it's so much harder today to put a new mine into production. I mean, the barriers from ESG kinds of things, and the reluctance of investors to fund the business, because most of the funding now comes from streaming companies. Very little in the way of bought deals, what I remember 15 years ago. There isn't, the capital just isn't there to build a couple of $1 billion new mine. So we're on a glide path lower in terms of production for the industry. But I think that at some point there will be a wake-up call, and I think that'll come about because of higher prices in the metal, and because these companies realize, and they know it. I mean, if I had talked to any CEO of a large company, they'd agree with everything I've said. But they're still hiding under their desks and looking at life with a rearview mirror in terms of taking advantage. To me, this is the time to be a buyer. They won't buy. I have to be careful what I say, but I don't think they're very good at selling low and buying high. And I think, don't write that down. But I think that's what's going to happen. But today, this is the incredible thing. You can buy an existing property that's producing earnings and cash flow at a 35% discount. We've done a lot of work on this, to what it would cost you to start from scratch. And this is not, it's obviously going to vary across the board, but it's that kind of discount. So, it would be obviously accretive, the premium to the target company, but it could also be accretive to the shareholders of a major making that acquisition. So to me, this is a time to be a buyer if I'm a corporate. But what are they doing? They're assuming reserves at $1,200 an ounce, and very little makes sense at $1,200 an ounce. So they're not going to make any acquisitions, and then they'll bump it up, and sooner or later, the investors, shareholders, and the investment banking world will be all over them to make deals, and they'll cave in at higher prices. So our strategy has been to position these many cases single asset companies that are driven, that are penalized because the headline risk for a single asset company. I mean, the best example today is Semafo in Burkina Faso. I mean, it's a terrible situation, but it's a great mine. It generates the company generates free cash. They have to fix it, and it will get fixed. But right now, that's an extreme example. But if Semafo were held in a broader portfolio, and it could have been Randgold, but it might be Goldfields today. But a larger company that had 7 or 8 different mines, yeah, sure, it would hurt the stock, but you wouldn't get this sort of dramatic, drastic reaction by investors to these admittedly very, very bad events. So we see many opportunities like this, and they're not necessarily in a difficult place like Burkina Faso. They're in the U.S., Canada, Mexico. I mean, almost any place I mentioned other than the U.S. or Canada or Australia will be thought of as having some sort of headline risk. And if you're a single asset company outside of the 3 jurisdictions I mentioned, you're penalized for that, being a single asset company. And even there's some companies, even in good jurisdictions, which have the same discount. So this is where we are today. When you look at the previous decade, when we went from gold was trading in the below 300, and there were similar things, different issues, but the hedging was one thing. There was a similar value, but not as good as there is today. And investor interest was absolutely zero when we started our gold fund in '98, as it is today. And there are many things that can change. But what you can see for sure is that the valuations back in '98, '99, and the valuations that are today will change for the better right across the board, big companies, small companies. And we can only guess at what the reasons are. But I think you have to start with the premise that the gold price is on a rise to higher levels. And I'm not talking about 1,700 or 1,800. I mean, most people think in those terms. But as Jessica alluded to, I was on a panel like this with David Rosenberg at the Precious Metals Summit in Beaver Creek. And David thinks, look, bonds have hit a cycle high. Stocks have hit a cycle high in terms of valuation, and gold hasn't. So would it surprise him for gold to say, pick a number, 3,000? He said, absolutely not. And what I like about it is that he is not a gold bug. Mm-hmm. He's, to me, a very rational economic analyst, and he's looking at all the things that I can see, and he sees them more clearly than I do, as to where we're headed from a macro point of view. And the outcome, to me, is very, very friendly for the gold price. And you have to kind of start with that. And then generalist money, and I wish I had a time frame, but it's years. It's not tomorrow. Generalist investors will come back because the space will be doing well in terms of earnings and cash flow. And then they'll discover, well, gee, these companies have been adding value, even though it isn't reflected in their share price. And then you'll see the sell side get more on their side, and they'll abandon their role as sort of handmaids to the investment bankers and actually pick stocks, which they're not doing now. And so all of these things will take place over a period, maybe even a full decade. But I think it is a long path. But we're in an upcycle in this space, and we're still at the very early stage where people are super skeptical, and maybe largely because it's the third rail of investment ideas.
And we will work towards more of those macro factors that you see coming into play. But keeping it just on the micro for this one last part here, your fund has held Newmont. So what was, at the time of the acquisition, what was your feelings about the deal logic there and how it's played out? What is your feelings on that?
Well, we do have Newmont. I like Newmont. We've always held it. We have funds that require daily liquidity. And so we need to have some measure of names like Newmont that are liquid, because you have to worry about the potential for redemptions. And so we have weightings, and we don't own Barrick right now, but I would consider that to be one if we had inflows, which we haven't. But our weightings in something like Newmont are a fraction of what they are for GDX. We have no weighting in Barrick. On the other hand, our weighting in Torex or Detour Gold is, and I should have had these numbers, but I don't. But I can tell you it would be 4 to 5, maybe even 6 times what it would be in GDX. So we're so skewed to the mid and smaller cap names where I think the value exists, and where I think you would potentially get much more of a lift from a better assessment by the mainstream investor of investing in precious metals. Sure, Newmont would be a good stock, and it will be, and Barrick will be good, and Newcrest, and we own Newcrest probably more than the other two, and Agnico and so forth. But where you really stand to get outsized returns would be you've got to go beneath the surface. And again, we're one of the very few firms that's doing that. Now that we're joining Sprott, we have amplified research ability to due diligence a lot of these kinds of things. So we're going to get even more skewed towards that strategy than we are now.
We've seen Barrick increase their dividend. Kirkland Lake just increased their dividend.
Terrific. Yep.
Newmont not yet. Is that the sort of thing that we're going to see more of to get the love back from the generalists?
Absolutely.
So that's on track.
And they can, because they're generating cash. Varying amounts, different companies. But 2 years ago, nobody would have dreamed, particularly in the executive suites of the gold mining industry, that we'd even be at 1,400, much less, knocking on the door of 1,500. And the industry has, kind of tamped down operating costs. The all-in sustaining cost of mining has been relatively flat for the last 3 or 4 years. And when you get a breakout in the gold price, your margins go wide and you start to gush cash. And they're starting to bump dividends, and exactly what they should do.
Great. I'd be remiss. I have one of the better active managers on the stage with me here. We had to we need to share with the audience a little bit about how you generate alpha. You've alluded to some of your big positions. Can you maybe take us through that? So I have some of your larger positions: Detour, Torex, West Dome, Pan American Silver, and Mag Silver. Talk a little bit about the key factors that led to those investment decisions and where you think why they're.
Well, everyone was different. In our mind, Detour was a very underperforming asset, and we got involved in a proxy battle with the incumbent board. Paulson led the charge. I'm not quite the pit bull that Marcelo was, but we maintained cordial relations with the outgoing group. But it was clear to us that the asset was underperforming. And by the way, that's a trophy asset. It's a 20-plus year mine life in Canada, low grade to be sure, but a big land package and the possibility for much more discovery. And I think the headquarter count at the time of the changeover of the board was something like, this is in Toronto, very nice offices in Toronto. Always makes me suspicious. It was, I think there were 40 to 50 people. They're down to 15. There's a lot of empty office space in Toronto, as you probably know. And, they brought in a good new board. They have a new CEO who is a tough as nails kind of operating guy. They were paying hundreds of millions to outside contractors. Now they've cut way back on that. And the operating cost of the asset have gone down substantially. And I am not good without my cheat sheets on remembering specific numbers, but they're generating free cash. And their debt is paid down substantially. And I think we're only halfway there in terms of where they could get just internal things, better equipment availability, less turnover of key mine people, all of that kind of thing. It just all adds up. And I think on its own, the stock has the potential to double from here without a takeout. But sure as shooting, going back to this wind down of reserves and industry production, that company is a trophy asset, and it's beyond me why somebody hasn't figured it out now. But I think they will, and I'm happy to own it without a takeover right now, because I think there's enough on the way of internal improvements that will carry the stock higher. But I think our exit strategy here, maybe 2-3 years out, is going to be a takeover at a big premium to where the stock is trading, hopefully twice where it is now.
Right.
So that's one. What else is on the list?
You had Wesdome. Some of the silver ones might be of interest as well. So Pan American Silver and
Yeah, Pan Am Silver, what terrific company, smart management. There are three things, out of the money, or some of the in the money calls on a higher silver price. Plus, they're generating cash, free cash, and paying a dividend, and basically what most sell side analysts know about. They're doing a good job with. But they had a big discovery, La Colorada, an existing mine, but a different mining structure, a different geological structure. It will be a separate mine, and they will be announcing preliminary reserves, I think in December, so not that far away. And that's here and now, but I don't think sell-side investors have figured it out. I don't think even most investors have, but this is like another mine, and it's right on an existing asset that they own that even they didn't know about 2 years ago. So that's a big plus. Then they took over Tahoe, a silver mine in Guatemala, which had been operating but then was shut down because Tahoe's management lost the social license. Lots of bad things about Guatemala, but not beyond being fixed. And that mine could generate, I believe, in terms of tax revenue to the government, 5% of GDP. It was just a huge thing. It's too big not for the Guatemalans to have a self-interest. And Pan Am management is essentially Latin-based, even though they're from Vancouver. But I think they'll do a way better job working with all the local federal and state authorities in Guatemala and the community. The community actually wants this to happen, to get it back and running. So once that is back and running, I forget what it produced, but it's a big mine. And then the furthest out of the money call is their asset in Argentina. And of course, it's Argentina. You're not paying anything for it, but one day Argentina won't be as bad as it is now. And I believe that is, and I'm not getting the names because I wouldn't even dare to try off the top of my head. That, and we've known about this, and people know about it. That's another blockbuster type of development that might be 5, 7, 10 years, or maybe never, but it's there in the portfolio and out of the money call on silver. That could, all of which would move the needle dramatically. So here's a stock which trades at a low valuation. It's not a takeover candidate. I think of this more as a management group which is very skilled at they're zigging while everybody else is zagging. They're taking advantage of the landscape, as they did with Tahoe, to take advantage of a distressed situation. They knew it would be a while before they could get Guatemala back up and running. But part of our thesis is that not only will companies be taken over, but there are smart management groups that will take advantage of a situation when very few other people are.
Excellent. I have a lot more questions, but I don't want to hog all of John's time. I want to be able to give it up to the audience. If I don't see questions right away, though, I'm going to jump back into my questions. I think we have one there at the back.
Yes. Your fund, what kind of returns have you had in the last 5 years?
It's been a tough 5 years.
I didn't ask how tough it was. What were your returns? That's all that the investor is interested in.
I understand that. And you could look at our fact sheets, which I don't have with me. I think we're plus 2 or 3%, something like that, but I'm honestly winging it. I really don't know off the top of my head. We have underperformed GDX because of our strategy of investing in smaller to mid-cap companies, so we hear that a lot. We do manage a UCITS here in Germany and a Swiss gold fund sub-managed for Falcon Bank here, so we do have exposure to this market. honestly, to answer your question, we have a website, and those numbers would be readily available.
In the front here, please.
John, I'm looking at that chart that's on the screen, and on the right, we've got Newmont, Barrick, Newcrest, Agnico Eagle. So you've got large market cap and large P to NAV ratios. I get that. These are the companies that, again, generalizing, had good production records and execution records and things like that, and the market seems to be rewarding them for this. Then in the left bottom, you have some problem children that had to revise their production outlook down, certainly lagged in execution. And again, I'm generalizing, just looking at the ticker symbols. So, and then in the middle, there's the bulk of the company. So, the question is, this sector has been burdened by poor execution, and therefore, kind of surprises to the negative. What would it take for the sector to perform better?
I think every company is a different story, and there are managements that have, Detour would be a good example, where it might take an investor like us and Paulson to become very active backseat drivers and either work collegially with the board or maybe slightly, I don't like hostile, but more confrontational, which Detour was, and that's a success story. And I think governance is still an issue in this business. I see too many boards where you have huge transgressions in terms of conflict of interest. We're all over it. We've had another situation, which I can't name, where we nudged the board towards a better resolution in terms of composition, succession in terms of the chairperson and so forth. So in some way, I mean, investors, up to investors to some extent, particularly with some of these smaller companies. And our idea in forming our special situations fund with Sprott, which is very concentrated, only 13 different holdings, as opposed to 35 to 40, which we would have in our mutual fund or our UCITS, where we, and having been in this space for 20 plus years, I've gotten to know virtually every CEO, or if I needed to, I could get to know them. My general impression is that they're generally very nice people. They're good at various aspects of mining, whether it's exploration or mine construction or metallurgy or all the different things that go into the execution that you're asking about. But when it comes to financial markets, they are absolutely clueless and naive, and they're taken for a ride by Toronto investment bankers, I think it's our job as shareholders, and you're not going to get this from an ETF, to work in a constructive way towards better outcomes. And I think but let's face it, mining is a very tough business. There are a handful of people in the space that create value, that have created value. And Tom Kaplan would be a good example. Ross Beatty might be another. I mean, they're there. It's not like they're absent. They're very good operators at various stages, but the adherence to best practices and I keep going back to Detour, where the transgressions were just. The more we got into it, the more we realized how bad it was and how much better it could become. And to me, again, that's the opportunity here, because if there's a better tone to the gold price, talent will come. And many of the mistakes that we're talking about arose from too much capital sloshing around and putting too much money to work at low return opportunities. So now we have the opposite. There's not enough capital, and the opportunities are enormous. So I love that as an investor. So I can't give you a good, succinct answer to it, but I think one part of it is that we, as shareholders, have to work with particularly the kinds of companies I'm talking about. Newmont's never going to listen to me. They'll listen to me, but they're not going to do what I say. Or, I mean, if they did, it would be accidental. But the smaller guys actually do look to us for inputs. And, yeah, we have a healthy dialogue with many of them to say, you know, strategy, financing, what's the best way? And I think that's part of the answer. I don't have the whole answer.
Well, John, time is our enemy, unfortunately. We didn't even have time to get into QE and monetary policy and all that sort of thing. We'll have to leave it there. But I take it, are you going to be here for the day if people have macro questions for you?
Answer,
right, so John will be here for that.
Yeah.
Excellent. Thank you for taking the time and sharing your thoughts with us.
Yeah.
Thank you. Thank you. Great job.